I was asked via personal message this week to dig into the details and explain the price drop in the metals we witnessed this week. In this video, I will share with you my conclusions based upon the data. It will be somewhat counterintuitive, but I think if you understand what I present, you will realize that there is something very powerful happening behind the scenes that is actually in favor of the precious metal investor who has the courage to hold or even accumulate through these nasty price declines. So with that said, let's get into the details. Okay, in order to really understand the material that I'm going to present to you, it's important to understand the basics of precious metals futures. I'm just giving you some real basic information here. You can obviously learn a lot more by going onto the exchanges themselves and looking up information, or even going to Wikipedia. But essentially a futures contract is just that. It's a contract. If you're long, basically you enter into the contract and you agree to purchase a given amount of physical good at a specified date and specified price. If you're on the short end, you agree to deliver a good at a specified date and a price. This agreement is always made between a long and a short, and the number of long positions on the exchange is always equal to the number of short positions. But basically it's a binding contract. Now this doesn't mean that the metal is always delivered at the end of the contract. In fact, less than 5% of these contracts actually result in transfer of the metal itself. About 95% of them are basically nullified. People go into what's called an offsetting position, which means that at the end of the contract what they'll do is they'll buy from somebody else the opposite side. So if you're long and you don't really want the delivery of metal, you would buy a short position from somebody else of the same amount in the same contract and essentially nullify your own position, and you wouldn't have to deliver any metal to anybody. And the shorts do this too. There's a great misunderstanding out there that this huge short position could never be delivered upon. That's actually true, but bear in mind that a lot of the people that own the long positions never really ask for the metal anyway. They usually purchase the short position at the end of the contract so that no metal transfer takes place anyway. Now in terms of size, the standard gold contract is for 100 ounces per contract, and the standard silver contract is for 5,000 ounces per contract. So these contracts are fairly substantial, and these are the typical sizes. There are other contracts that deal in different sizes, but this is standard. Now, one of the primary features of futures is that it involves leverage. This is what attracts a lot of people to the futures market, because you can use a relatively small amount of money to control a large amount of physical goods. So, for example, in gold, you can put down a little over $7,000 and control 100 ounces of gold by buying one contract. Similarly, for silver, if you put down a little over $12,000, you can control 5,000 ounces of silver. And this creates an opportunity for great profit, but at the same time it creates a lot of risk. If you put down the minimum initial margin, it could wipe you out if the price moves against you. Now, to manage the risk of disorderly defaults, the exchanges provide clearinghouses. So they have clearing members who act to manage the risk. So every day they take a look at where everybody's position is relative to the maintenance margin, and if they fall below, their positions could be liquidated. And every day cash is transferred from the losers to the winners' accounts. So all throughout time, the actual balances are adjusting. So this is how the exchanges manage risk, and the exchanges also provide warehousing services. So their members have metal on hand. Quite a bit of it is eligible, meaning that it's metal that's already been purchased or paid for. People have warehouse receipts, and they could ask for delivery anytime they like. The rest of it is in the registered category, and this is typically warehoused by the bullion banks, who have vaults, and they offer vaulting services to various people. But this metal is on hand, and it's available for purchase from the bullion banks. So anybody who engages in a short contract at the expiration date, if they are to deliver metal, can always purchase it from the registered category from the bullion banks. Now, who are these participants in the futures market? Well, they're generally broken down into commercials and non-commercials. The way that these players are distinguished is that the commercials typically either provide metal or they have a use for the metal, but they're metals handlers. and they're interested in hedging the price because they are dealing with a physical transfer of asset. So the commercials are hedgers, and they want to insure against price movement. So for example, if you're a metal miner and you're interested in locking in a profit, what you would do is engage in a short contract whereby you promise to deliver metal at some point into the future in exchange for some money now. So the mines will actually use the futures market, and they will act as the commercial shorts. You have other users such as mints, manufacturers, and jewelers who need to obtain the metal, and they'll typically do so through the futures market. They will engage in a long contract so that they can lock in their price and promise delivery of goods in exchange for money, and at the end of the manufacturing period they could deliver the good and be assured of making their profit. And then in between are basically the banks. These are vaults and lenders, and they can go short or long depending on the circumstance, so keep that in mind. The non-commercials are basically speculators. They're interested in betting on price movement, and they're also sometimes interested in procuring the metal for investment, but they're primarily interested mainly in the price movement. They want the dollar profit. So what's interesting and necessary to know here is that, contrary to what most people think, banks, bullion banks, specifically because of gold loans, and you can look up the topic of gold loan on your own, these banks are considered commercials. Okay, they're not really speculators. They're commercials. They're hedgers. And these would include banks such as Barclays, Scotia, Macata, Deutsche Bank, HSBC, JP Morgan, and UPS. So whereas most people would think that these banks are, playing the market long and short for paper profit, they're actually interested in hedging the metals prices. Okay, so now that we've gotten that background out of the way, let's look at some charts. What I did here was I took the Commitment of Traders reports all the way back from January of 2004 up to the present. Now, the Commitment of Traders reports is basically just a summary of what category of investor holds what position at the end of the week. Typically, the reporting period is Tuesday to Tuesday, and the report is put out on Friday by the CFTC. And what we're looking at here is the net position of the commercials and the non-commercials in the silver market. And I've scaled the data so that it's measured in terms of millions of ounces. And what you can see here is the typical view. This is what everybody's common understanding is that the commercials are the big shorts. They're the evil bad guys, right? And they're always acting to suppress the market. And they have uncovered shorts. They're unable to produce the metal on demand, and they're just holding everybody down. The non-commercials are seen usually as the good guys, and I'll fight this perspective in a minute. But you can see that they're net long and have been for the past decade. You can also see the nature of the contracts here. For every long, there is a short. And what you can notice is that despite the fact that the commercials have been net negative over the past 10 years, it has been trending up. So the commercials have been getting longer and longer over time. And in fact, recently, just this year, they've come pretty close to being net neutral. And this is interesting. But this really doesn't tell the whole story. So let's take a look at this data in another way. Okay, so here's the same data, except I've presented it in a different way. I've added a little bit more granularity here. It shows the commercial long and short positions on the top, and the non-commercial long and non-commercial short position on the bottom. And you can see the roles that the various types of contracts play here. So for example, the top red curve is for the suppliers of future metal and the borrowers of current money. So for example, the mines, who basically bring a mine into production, they need to borrow money in order to do that, and they know that they're going to produce a certain amount of metal in the future, but it's not available for sale yet. So in the meantime, they have this loan, and what they're going to need to do is they're going to need to hedge the price of that future metal so that in the event that the price declines on them while they're trying to produce it, they're able to actually pay back their debts. So they're trying to insure against a profit margin squeeze if the price of the metal goes against them. The bottom blue curve on the top graph is the commercial long position. So these are the consumers of future metal. Take, for example, your local coin shop who sells coins. All right, well, they need to replenish their stock. How are they going to do that? Well, as soon as they sell the metal, what they'll do is they'll go out and they'll take a long position so that they can basically lock in future production so that they can secure their metal. And if the price increases in the meantime, they'll be able to take the money that they just received from you, the coin purchaser, and obtain the same quantity of metal that they just parted with. It's a natural market operation, and the futures market makes sure that the exchanges of metal are handled in a way that's profitable for all the players. The folks on the bottom graph here are the non-commercial long and the non-commercial short, and we'll talk about them a little bit more in just a minute, but just bear in mind that these folks are the ones that are taking the offsetting positions against the folks on the top. These are the insurance providers. They're basically speculators. They're interested in the paper profit if their guess about the future price movement is right. Now take a second and take a look at these charts. Compare the top against the bottom. Are there any important patterns that you see? Well, you'll notice that there are two lines, or two curves, one blue and one red, that are fairly non-volatile, and they tend to follow each other quite well. And then there are two other curves where the movements are quite volatile, and they also tend to track each other. So let's rearrange things a little bit and see if it can provide some insight into what's going on here. Okay, now we're getting somewhere. You see the relationship between these curves? So you can see how the different participants interact with each other. This is very important. You can see on the top we have the commercial shorts. Again, these are the mines. These are the people that are supplying the metal. So they're supplying the future metal. They're borrowers of current money. They need to insure against price declines in the meantime, between the time in which they engage in the contract and the time at which delivery actually occurs. On the top graph, you have an offsetting curve. These are the speculators. They're providing insurance by agreeing to cover losses if the price declines. So you can see that the non-commercial longs are providing an insurance service to the commercial shorts. And the movements are very, very close to each other. I mean, they're almost identical. There has been a slight drift in terms of the data. And what's interesting is that seems to have drifted ever since the SLV and the GLD came into existence. And so the SLV and the GLD may be taking up some of the slack in terms of the futures market and the insurance facilities here. Notice again on the bottom we have the commercial longs. These are the people who want to procure metal in the future, and the non-commercial shorts. Again, these positions tend to track each other fairly well. There is a small divergence that's been growing over time ever since about 2005 when the ETFs were introduced. But you'll notice that the movements, the short-term direction, they track each other fairly well. So we have the consumers of future metal who are lenders of current money, who are trying to insure their positions, and the speculators who are on the short side providing the insurance. So they're agreeing to cover losses should the prices increase. Now, one other thing to notice on here, and this is very, very important. Now, according to the Silver Institute, silver fabrication demand has been flat ever since 2004. It has not increased. Let me say that again. Silver fabrication demand since 2004 has not increased. So why would the commercial long line be increasing? In fact, it's been increasing since 2004, and it's up by a factor of 4 or 5. Let me say that again. There's no new fabrication demand, but commercial longs, the people who procure metal, have increased their positions by a factor of 4 or 5 over the past 10 years. Well, I don't know what your explanation of this is, But my explanation is that it's the banks. The banks are commercial. The banks deal in the physical transfer of metal. The banks have been building their position. They are trying, for their own sake and for the sake of their clients, to build a long position in silver. Take a look at the top curve, the commercial shorts. The banks are in there too, just as the mines. Mine production has not increased all that much over the past 10 years. But notice, the short position is fairly flat. So what this says is that the banks, who are part of this group of commercial shorts, have not been increasing their short position. But according to the bottom curve, they have been increasing their long position. The banks are trying to corner the market on future silver production. Okay, so what about gold? Well, gold is presenting essentially the same picture if we overlay the curves on top of each other like we did for silver. You can see on the top we have the commercial shorts with their need to hedge future production plotted against the net commercial longs, who are providing the insurance function for price movements. And then on the bottom we see the commercial longs, who are the fabricators and investors who want to actually acquire the metal, plotted against the non-commercial shorts. So you can see the same kind of a trend over the past 10 years. There has been a buildup in commercial long activity. These are the banks. They are acquiring long positions against gold. In other words, they're locking up future gold delivery. They're doing this for themselves, and they're doing this for their clients. So who are their clients? Well, we've already discussed in my previous videos that there are other interests who are interested in acquiring gold without increasing its price by a great deal. These are the folks in Asia with a lot of money flowing in who are interested in converting it into gold and silver. And these are the OPEC nations who are getting a lot of money for their oil, who are interested in investing that cash and obtaining real assets for it. So they put the money into sovereign wealth funds, and the sovereign wealth funds are very, very private organizations, but they work very closely with the bullion banks, who are very active in London, and they're acquiring long positions on gold and silver so that they can acquire it quietly from future mine production. And frankly, looking at these numbers, it looks like they really are cornering all future production. Okay, so I've just presented a lot of stuff to you. A lot of information, a lot of trends, and a lot of interpretive work. So what does this have to do with why the price of gold and silver declined this week? Well, let me give you my take on it. Well, we can conclude from the previous charts that the bullion banks and their clients are buying. It's something that I've been saying for the past, 20 videos or so. They want the metal, and they want it at good prices, and they want to secure the metal without the price increasing a tremendous amount. Because as soon as the price starts increasing and creating a trend, that's when the speculators hop on board and they basically ruin it for the people that try to obtain the metal. They engage in long positions and they drive the price up even further and make the metal more expensive. So what's the best way to corner future production? Well, it's to engage in a long contract with an offsetting short, from the speculative side, and lock in a guaranteed delivery from the mines at some point in the future. Doing this is a way to secure your metal without increasing the price. So they actually want the price to go down because they're trying to obtain metal at good prices. So how do they do this? Well, they know that the long speculators are highly leveraged. Remember, the speculators are only interested in paper profit, and they really, really want to make a killing. So they go into these long positions, highly leveraged. They put down the minimum possible margin requirement, and they're very visible. So when you're a bullion bank and you engage in a short position, what you can do is you can run stops. Okay, you do this with program trades where in the thin of the night, in very thinly traded markets, you basically put out, offers to sell metal, and you do it in such a way that you basically test the limits of the people who have the long bets. You see where their pain points are. At some point, you're going to trigger their stops, and you can potentially cause a cascading list of sells from the people that were long. They just bail out of their positions. So you can use a very small amount of money to run those programs and get them to sell off a huge amount of futures at a point in time where there's really nobody to respond. That drives the price down, and that gives you the opportunity to establish your position. So if you're a bullion bank, you're going to establish your position very slowly and quietly by putting out or engaging in long contracts and doing it in a very disciplined fashion. So on the short end, you're taking advantage of the leverage of the speculative longs, but on the long end, you're putting in place your contracts in a very disciplined manner and taking advantage of the low price. And believe me, bullion banks are the best at what they do. They hire the best of the best. They do this for a living. They know how to work the market to their advantage. And the Commitment of Traders reports that I just showed you basically reveal that fact. They know exactly what they're doing. And it's not that they're just trying to suppress the price for the sake of depressing the price. They are trying to depress the price in order to obtain metal, because they know where it's going long term, and so do their clients. And this is all very bullish for the metals.